I'm John Zimdars, president of the Zimdars Company. Our firm is a third-generation independent life insurance sales and consulting firm. We are often asked how much life insurance is needed for family protection. The information we will provide today is primarily for a young couple with children or anticipating having children in the future. What we will discuss is a relatively simple model to help you determine the approximate amount of life insurance to protect your family. There are usually two purposes for personal life insurance. The first is to create a fund of money for major expenditures, such as paying off a home mortgage or other debt like student loans, or establishing a children's education fund. This does not mean that debts would necessarily be repaid in the event of death, just that funds would be available to do so if it's appropriate. The second purpose is to provide a fund of money to be invested to replace after-tax income that is lost from the insured's death. To calculate the amount needed, you have to assume an after-tax rate of return and determine the annual after-tax income that is needed. For example, if you assume a 4% after-tax rate of return, $1 million invested produces $40,000 per year after-tax income. If you need $80,000 a year of after-tax income, that would require $2 million invested to produce income based on the same assumptions. When you add together the total money needed for major expenditures, repayment of debt, establishing an education fund because the individual hasn't lived long enough to set aside earnings for that educational fund, and to replace income, you have a total of the funds that are needed to be invested to protect the family. You can then subtract your current investments and existing life insurance. If there is a shortfall, additional life insurance may be needed. It is always our recommendation to make sure there is adequate life insurance protection. If the person to be insured is in relatively good health, the cost of term insurance is usually very reasonable. Our first recommendation is to do everything possible to make sure your loved ones will be adequately protected financially if you die. And secondly, to make sure your life insurance is likely to continue on an affordable basis for as long as the protection is needed. Again, talking about term insurance, it's possible to purchase term insurance with a guaranteed level premium for varying periods of time, typically either over a level premium over 10 years, 15 years, 20 years, or 30 years. For example, a person in their 20s or 30s with young children is probably better served with term insurance that has a level premium for 20 years or 30 years as compared to a 10-year level premium policy. If there is a stay-at-home spouse, how much life insurance is needed on this person's life? There are probably three considerations. The first is the same consideration for total or partial mortgage repayment, student debt loan repayment, and also partial or total funding of educational funds. The second is to determine the funds for child care services that would need to be replaced in the event of the stay-at-home spouse's death. The third possible life insurance need is less obvious, but very important and seldom discussed in a financial planning context. If the primary income spouse would reduce their workload as a single parent, enough money would need to be available at the stay-at-home spouse's death to replace the surviving spouse's loss of income. This is a very summary analysis. It does not take into account possible Social Security benefits or the impact of inflation. It's possible to make a more detailed analysis, but you must also remember you are making more assumptions in an effort to project into the future. We have tried to make this analysis relatively simple and yet inclusive of the primary factors involved in determining the appropriate amount of life insurance each spouse in a young family with children or anticipating children might consider. If you have questions or we can assist you further, please contact us. Remember, the two most important decisions are, number one, to make sure your family is adequately protected as much as your budget permits if you or your spouse should die. If there are budget constraints, consider low-cost term insurance before higher-cost, more permanent insurance. Number two, try to design your life insurance to lock in a relatively low premium for as long as the death benefit is needed to protect your family.